So Qualcomm's revenue growth has been solid, not excellent. Over the previous decade, it's increased its revenue from 25 billion up to 43.3 billion. Qualcomm is a dominant player in the smartphone industry, collecting royalties on the majority of 4G and 5G smartphones being sold. Additionally, Qualcomm is benefiting as smartphone makers are incorporating more technology to incorporate artificial intelligence and increased computing power. One of the more exciting things about Qualcomm's long-term revenue growth potential is its expansion into the PC and automotive markets, where it's making significant gains. Investors can be excited about the company's revenue growth rate that's likely to be better over the next decade than it has been in the previous decade. Not only is Qualcomm generating solid revenue growth, but it generates significant returns on invested capital, given its business model where it collects royalty income on its licenses, on its patents, and in that way it generates asset-light revenues and is able to generate strong returns on the capital it does invest, mostly in research and development. Its returns on invested capital since 2019 have never fallen below 22.6%, which is nearly double its weighted average cost of capital. And if you didn't already know, a company is increasing shareholder wealth when its return on invested capital is greater than its weighted average cost of capital. So Qualcomm, with its ROIC to WACC ratio approaching 2, at least 2, closer to 3, with 31.8% in the most recent trailing 12-month period. Qualcomm has demonstrated volatility in its operating cash flow to sales ratio, but again falling the lowest at 17.3%, which is still a solid operating cash flow to sales ratio. Over the previous decade, this figure has fluctuated between 17.3% and 32.4%, ending the most recent trailing 12-month period at 29.3%. If I were to draw a line here from 2015 to 2025, you can see a nice upward trend in its operating cash flow to sales ratio. So even though there's volatility between the years, over the longer term, when you look at the trajectory, it's moving higher. And that's what I like to see. And it's especially important for companies that already have a strong operating cash flow to sales ratio. For them to be improving that ratio demonstrates that the sustainability is there, and it could potentially continue improving this metric over the longer term. Still, the current market price at $161 is well below the intrinsic value per share of $218. So even if I were to apply a margin of safety, which I always do, the stock looks undervalued at current market prices. Click the link below to watch the full video.